Eddie Perkin is here with us today. It's good to see you again. You have a contrarian position almost across the board. Earnings growth is going to be weak. Stocks are going to rise. Cash is going to be trash. Fear of risk is going to morph into fear of missing out. How positive and why are you so positive?
I think the story of the last several months has been positioning. People got very negative about China, very negative about the economy in the latter half of last year, and then that was compounded with tax loss selling in December. Now we've seen a reversal. It's all about positioning. Last year, we had earnings growth. We'll know when we get the full fourth quarter numbers in, but probably 22% for U.S. earnings. That's phenomenal earnings growth, and yet the stock market was down. I think 2019 is going to be the opposite of that, where earnings are muted, but stocks are up because positioning is so negative right now.
But you know that earnings growth is slowing and slowing fairly dramatically.
The world knows
right?
that. It's not new news.
It's going to be probably pretty ugly.
It may be, but the market is forward-looking. The market is a discounting mechanism, always looking forward, and so I think we'll look beyond a soft patch of earnings, and then we'll get back to kind of regular earnings growth. And the stock market is cheap on, and parts of the market are particularly cheap on near-term earnings.
All right, it's provocative. Let's kick it around. Do you agree, Kevin O'Leary?
I'm a little concerned about where we end up on earnings growth S&P for 2019, given these calls that we're starting to see from the big guys, the CAT call, then the Pfizer call. Everybody's pulling in their horns a little bit. My basic premise for 2019 is I have to be long equities because I don't know when the China deal's coming. And the timing may be perfect because China's starting to hurt. They know they've got to do a deal. We've got the whole infrastructure working on a deal. I got to be long equities when they come out one morning and say, we have a deal on IP, right. We have a deal. We're going to be up 10, 15%. So where do I hide? I'm hiding in the weeds in the big cap names that aren't going to take you down 14%. I'll do some P&G. I'll do a little Pfizer. I'll buy stuff that isn't going to kill me when they have a soft call. I'm not going to be an NVIDIA. I don't want to lose 14% in the first trade.
Oh, I'm surprised, though, the names you're buying. 3M, Pfizer, J&J, P&G,
boring.
Tri-True.
Boring. I bought all those today. I bought more of those today. I got to put money to work. Where do I hide?
Steph?
Show me a better place.
So how about that? I mean, is that not the biggest risk to investors? You get so negative and you get a trade deal, as China says, and the market whooshes higher.
Yeah, I mean, it's clear the U.S. is slow. It's clear that earnings are going to slow. The valuations reflect that. Sentiment reflects that. And we talked about this a couple weeks ago when the banks reported earnings and they rallied on okay earnings. And same with semiconductors, semi-cap equipment. I mean, they were on fire last week, and they actually, many of them didn't have anything good to say.
Xilinx was great.
Xilinx was great. I own it. I love it. But, I mean, Lam was good. But, I mean, to be up as much as it was, it's just very telling to the point of positioning. Absolutely. I think what's very interesting is outside the U.S. what's going on. The EM has clearly bottomed. China, the second derivative in terms of retail sales and auto sales, the second derivative. It's less bad. And Brazil is up 16% year to date. Outside the U.S. is actually more interesting at this point than the U.S. to me.
But, Eddie, how do you reconcile what is a pretty positive call overall in the market? You got Stanley Black & Decker, NVIDIA, CAT, Intel. There's some big companies that have delivered, let's say, less than desirable and stellar results. How do you reconcile that with your point of view?
Yeah, because I think everything you just said is largely known by the market. We know, as you said, we know that earnings are going to slow. I think they'll still be positive in 2019. But we've seen far more companies report mediocre results and have the stock price go up rather than companies like NVIDIA yesterday fall on bad news.
Eddie, you're representing a long only pretty much. I know the fund lineup. I know you have some alts, but you guys are long the market. What would it take for you to ever go negative and say now is not a good time to invest? You never would, right?
I think, we go back a year when I was on this show, I was talking about buying utility stocks. I was talking about buying REITs. I was talking about buying some of these boring companies because I thought the market was too frothy.
Well, that turned out to be good advice. Yeah. The only two sectors in the S&P that are anywhere near 52-week highs are REITs and utilities.
Right, and I would not be putting fresh money there today. I think those are the parts of the market that are simply too defensive and expensive, and I think you want to take risk. Risk is cheap, and so it's a time to be bold, not fearful.